Hello and welcome to the Harwood Report for November 20th, 2018, presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are for educational and informational purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of the disclosures and then I will get to the charts. All right, that should do it. So, we've had quite the crazy day and crazy start to this week and crazy end of last week. Everything is just moving a lot off of headlines. And I think part of this is, people talk about holiday markets being, a time where volatility gets driven lower and people start to grind higher. Well, holiday markets are also a time where liquidity can kind of fall out of the marketplace and we don't have a natural buyer or seller. The reason that we tend to grind higher during those holiday markets is because there's just not a natural seller. Tax law selling has already been completed and people aren't necessarily making big moves in November and December on their portfolios. Well, this time it seems like people are making big moves on some of their portfolios, particularly in those big names. Apple, Nvidia, those big earnings names created a time where people had to move. What did that do? It created some illiquid activity. We saw what happened today in Apple. It's already $5 off the lows, but it's still down $5. Things like that are, I think, the nature of these holiday markets. And we could just as easily see Apple up $5 by the end of today based upon this kind of lack of liquidity. Now, I'm not calling for Apple up $5 on the day. I don't think that's necessarily going to happen, but I'm just giving you sort of the extreme scenarios. We'll take a look at TLT because bonds haven't really reacted as much as I would have normally expected during this last wave of selling. I think that's also partially telling you that people are liquidating as opposed to hedging. Same idea with gold. Liquidating, not hedging. Even the VIX, liquidating, not hedging. And then oil obviously just fell out of bed today. And we'll have to take a look at some of what's driving that. Before we do any of that, though, let's look at fear and greed. I think this is an important thing to look at all the time. It's at 8. It's extremely low. It's as low as it's been since 2016 and the February break. So we had this February break. This chart is looking a lot like the February move for me. So you just kind of draw a similar chart here. Okay, so we had the big break. We had the little bounce and then a fall, little bounce and then a fall. A little bit bigger bounce. This one did better, but this had the bounce and then the fall back down to the lows. And then within a couple of days, we started the trend, the reversal of that move. So I think we're getting close to the bottom here. I think this is almost done. Today's action actually looks like that as well. Let's look at some of the individual stuff. VIX didn't really spike. It is up today, but it didn't spike like crazy. We're not seeing that many new 52-week lows in spite of everything going on here. That's who cares. That is who cares to me. This is, another sign of some of the stuff that has been going on. Obviously, we are seeing better breadth than we did 2 weeks ago at the October lows. So the breadth is improving while the market is basically trying to bottom here, retesting previous lows to potentially go up. So, before it basically took a little longer. We had that rounded top thing and then a pullback. This time it looks to me like we just had the bounce pullback and then this would be the grinded out a little bit with a little bit of chop and then we go. So if I look at that on the chart here, this is basically where I'm saying we're at right now in the chart is kind of in this area. We may have a little bit of chop here, but as soon as we start seeing a little bit more firmness above the 10-day moving average, the 10 moving above the 20 moving above the 50, all of these things starting to restack, that's how we'll know we're out of the problem here. Okay, so SPY, to me, is a little bit of a bounce play where my main goal is to capture a fall in the VIX. So if we're in that area here, it means the VIX needs to start grinding back down towards this big moving average at 16. It'd be the 200-day moving average. And that would be the major real support line here. We could have a little bit of chop, but then as soon as it starts to go, it's going to go. We get down to 16. That's going to help put some confidence back into people. And I think that it's natural for the VIX to drop like that going into the holidays. We go over to IWM. We'll do that first. And you can see that this has retested the lows, but it is, it was the worst performer at the beginning of this. So if we start to see IWM turn around, I think that's a better sign for the overall market. I'm looking for a potential where if IWM shows a higher high and a higher low, then we look for a bounce back to 158. Volatility is still relatively high, but it's not massively high. So there are ways to play this in the options market that you can get if you sign up for the newsletter. I posted my way of looking at this yesterday. The market has fallen a little bit more, so it's a little bit better pricing today. But general idea for me is when you've got a high volatility element and a sort of natural point to target here in the 156 to 158 range, then we start looking at butterflies and condors because we're looking for volatility to fall into a rally. Again, I talk more about that in the newsletter for subscribers. Let's do Qs. Qs were the worst, of course, because of things like Apple and Nvidia. So we see Qs basically open near the lows, made a new low, and then now it's starting to bounce. If we can get above yesterday's high, that's going to be a really big helper for the bull. But right now, we still have a little bit of work to do. Obviously, that's still not a bullish chart, even getting above yesterday's low. One of the key names here is Apple. All of the stuff about China is just scaring people on Apple, and we are just, falling out of bed. They have a corporate buyback program in place. If that buyback starts to get a little bit of more momentum here, and we start seeing people thinking about the FOMO buy the dip, then maybe Apple actually can lead us out, but I'm not expecting Apple to be the leader here. I expect Apple to be the benefactor of perhaps some buying in the semiconductor index. So we see the semis have performed better than Apple. It opened right at the lows, which instead of opening way down, tanked and bounced, and now it's green on the day. Semiconductors are up on the day. So if semiconductors and small caps start to lead us out of this, like they led us into the fall, maybe that's our signal. That's our clear sign that the market has found enough selling pressure. So how do we find that? Again, we got to get above these moving averages. So we got to see SMH still up another $3 or so before I'm really too excited. But if we start getting that, I'm starting to get signals that we can toe in on the long side instead of looking to sell rallies. So towing in on the long side is the play for me right now, with a little bit more aggressive longs as we start crossing moving averages. If we don't cross those moving averages, then the bounce just gets faded out, and we take off the positions into the bounce. But I think we've got the likelihood of a dead cat bounce that could turn into a rally if we start getting some better signals. Of course, China trade talk and everything else could drive the market. FXI has pulled back a little bit today after testing the 100-day moving average yesterday and the day before. So we got to watch that, but it is still above the 10-day moving average. China is a natural, FXI, the Chinese stock, large caps, whatever stocks, is a natural index to watch for us as another signal that the market bloodbath is over. So we've got, weakness in the VIX, strength in SMH, strength in FXI, strength in IWM. Those would be my real indicators that things are starting to turn back bullish. TLT, not doing anything too crazy. It has, kind of been grinding higher, but it's not going anywhere. So we're not seeing that flight to TLT. Yes, positioning is actually very short in TLT, but people seem to have this confidence that the December rate hike is still on, and the 2019 rate hike cycle, is still basically where it was before, which makes me think again that people are worried about risk right now in the equity markets, but expecting it to get resolved well before the next rate hike cycle that is of concern. So that would be, like a March rate hike or maybe a June. December is probably going to happen. 3 months later, do we hike again? That's the question mark for the market right now. It seems like the answer the market is trying to say is, yeah, we're going to stay on our path unless this turns into a longer lasting problem. And they're basically betting it's not a long lasting problem by keeping bonds where they're at and yields where they're at. All right, we go to the dollar. Remember, dollar strength has been an indication that people are going into the market, and we're seeing dollar strength today. This is not good for gold after having some dollar weakness for 4 days. Dollar yen is bouncing back, but it's still a lower high and lower low. So gold has a slight bullish tint to it, but it's not crazy. And thus, we sit. So, I actually was talking about this as a calendar play potentially in the premium newsletter. And again, sign up for that now because you get it for a week for free if you sign up now. So a free week allows you to see some of the ideas and determine if there's how much extra value you can get out of that relative to this one short video. I talk more about volatility analytics and things of that nature there. We'll skip the miners and the silver because it's just not that interesting right now. USO is more interesting to me. So USO, obviously, the last 3-4 days, basically this week, it looked like we were going to try to consolidate, and then today just fell out of bed as the 10-day moving average started to catch back up to the price action. So oil falls again. Short gamma is a problem there. A lot of producers hedged with prices a little bit higher. We've gone through those put strikes. Producers don't buy back or sell out their hedges into the fall. They're hedging production. So now they can produce and sell at this, and basically have the opt-in to sell at a higher level, or if they decide not to do that, then they just stop their production, and then they would sell out their puts. Right now, they're clearly not selling out puts or hedging against their protection. They need it. So people that are caught long the market via short gamma are stopping out of their positions instead. This will come to an end at some point. Maybe we need a fundamental input. Maybe we just need the market to bounce back and start showing signs of strength and global growth. But for the meanwhile, it is still a trend is your friend, and the trend is down. And these trends can just be merciless in some of these commodities, as we've also seen in natural gas. I'll just show you the natural gas chart because it is an important one here for trading. It's not something that I do a lot with because UNG, it doesn't have the most liquid options, but you can see how crazy this kind of move is in the last week and a half in natural gas off of expectations of a cold winter, and again, some positioning getting caught off, some people getting caught out of position. Because of the USO fall and because of the equity market fall, one would expect XLE to be at new lows, and it's not there, so it's showing some signs of relative strength. This is giving me another indicator that maybe the oil stuff is a little overdone and a little bit more based upon futures positioning and positioning within the oil contracts. But again, these things need to find support from the equity markets, both XLE and OIH, and XOP, all of these indices. They need to find support from equity markets and support out of oil in order to generate a bullish signal for me. So a lot of this stuff is kind of sitting on my hands and waiting for that bullish signal because we've gotten so overdone to the downside that it's really hard to press the downside easily with options. But there are ways to get a lot of leverage for a bounce with vol falling versus a fall with vol maybe just staying the same because it's already pretty high. All right. So that's what I get into in the Harwood Report. Sign up for the newsletter now. It's $49 a month regularly. You get a month for free. A week for free. A week for free, not a month. You get 1 week for free. And then after that, it's only $49. Take a look. You'll see more of this value. I go into more depth in the newsletter, and then I also do a midweek video update. So take a look now. Feel free to email me, keith@tradeacademy.co, if you have any comments or questions. Thanks again, folks. Have a wonderful rest of your day and a great Thanksgiving.